But the smaller the market, where they'll actually lend, typically the lower your interest or higher your interest rate is going to be. Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello and welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer. With me, as always, we got Matt Jones. Matt, how are you doing, man?
I'm doing fantastic. How are you doing, Todd?
I'm doing well. I'm doing good. It's actually a Monday today, so even though this will be released on Wednesday, but it's a Monday, and we actually had our live mastermind meeting this weekend, and that was good. You were there. I felt like it went pretty well, and it was just nice to get everybody together and really be able to spend some time, talking about what's going on, and I thought it went pretty well.
Yeah, I agree. We learned some good information about syndication and building our real estate businesses, but also had some fun too, throwing axes and such.
Yes, we threw some axes. That was good. Nobody cut their head off or a finger or anything. So everybody's still got their fingers and toes. That's good. And then we did what's it called? Like a
escape room.
Escape room. And that was really fun. I didn't know how fun that would be. I thought it was really fun. Like just challenge. It was challenging, and it was we had to kind of work together and also separate, but it was pretty fun. So good times. So it's good to meet, or be able to meet face to face. We had been doing all these virtuals, and that's kind of how the group is set up anyways, not COVID, but we haven't had a chance really to get together until now. So it's good.
Yep. And I really recommend our listeners, if you really want to advance your business career, join a mastermind or get a coach, because that's going to propel you faster than you could on your own.
Yeah, and the nice thing, my light's going crazy, Matt. I don't know what's going on here. The nice thing about like a mastermind is you've got a lot of people to lean on. You've got you've got various opinions and various experiences, and opportunity to really learn from each other. And so that's nice. And of course, you create relationships, you create that trust, and you create potential partnerships, which is great as well. So I really obviously think they're fantastic. I mean, I run them, so I guess there's a reason for that, but I think fantastic. I think it's a great way to really expand on your business. So Matt, let's dive into today's topic.
Yeah, today we're going to talk about the different kinds of markets. There's primary markets, which are sort of the city center, the main hub population, secondary markets, which are the surrounding areas, suburbs and such, and then tertiary markets, which are, in the middle of nowhere kind of thing.
Yeah. And I wouldn't go as far as middle of nowhere. Like those are, I don't know. I don't even know what their name is. Tertiary probably covers those, but tertiary could be as, like a smaller market, like 200,000 people in the city. That could still be typically is tertiary. It's the MSA could be, and MSA is the metropolitan service area. So it's think of your city plus the suburbs. Okay. So, you've got the Twin Cities. We got Minneapolis, St. Paul. Well, Minneapolis has a population of roughly 400,000 people. St. Paul is roughly, I think it's just under 300,000. Okay. But so each individually, those are small markets, not huge, right? But then when you add in the whole MSA, all the suburbs, we come up with 3.8 million, depending on, what statistic you're looking at, but about 3.8 million people. Now, all of a sudden, it becomes a fairly decent size metropolitan area. So that's what the MSA is. Well, obviously, when we're looking at smaller markets, typically we have a smaller MSA because we don't have a ton of suburbs around a city that's 100,000 people. Typically, sometimes we do, but yeah. So that's kind of that tertiary markets, that smaller market, like you said. The primary market's going to be like your New York City. Actually, the Twin Cities is considered a primary market. Dallas, Austin, Houston, LA, San Francisco, those are the big markets. And then your secondary markets are just a little bit smaller. So you've got San Antonio, you've got, Cincinnati, and you've got, I don't know, there's populations where they're like 2-3, Oklahoma City, 2 to 3 million, maybe a million. And then you've got your tertiary. So like Lexington, Kentucky is tertiary, smaller market. So differences in between, and there's good and bad with both of them.
Yeah, and I think everybody has their own niche of like what they like, and
Yep.
it just depends on your investment strategy. If you can handle the competition, or you want no competition, or whatnot.
Right. Yeah. And so we could talk about that a little bit too. I mean, you got a big city. Really big cities typically are fairly stable, right? And so that's why they're these primary markets, because when they have these massive populations, it's challenging to have these massive, you typically don't have big, sell-offs. However, we are seeing it in some markets. Like New York City right now is having some challenges. They were before COVID, and COVID has kind of sped those challenges up. Now, will New York City bounce back? Well, the lenders are betting on that it will. Like they consider it a primary market, and it's a primary core market. They're going to give you the best rates if you invest in New York City. So they're hedging that New York City is going to be strong no matter what. And maybe it sees a little bit of downturn right now, but they're, at least right now, they haven't downgraded it. So they're saying, yeah, it's going to stay strong. Same thing with like the Twin Cities. We're a primary market, and we're a primary plus market. Lenders see us as a really strong, stable market. So you can actually get a loan in the Twin Cities on a multifamily building with showing only 1 month worth of financials. Okay. Where a typical market's 3 months or more. So Minneapolis is considered such a strong market that we can just show a T1, okay, the trailing 1 month of financials, and they'll base the loan off of that because it's so strong. They're going to give you the best rates and terms and all that kind of stuff. So that's probably, I think, one of the bigger differences is for the lenders. Okay, what are they going to provide you, right? If I'm in a primary market, the lenders are going to give you the lowest interest rates. They're going to be able to leverage the highest amount. So when we're talking, we want an 80% LTV, and the primary markets are going to be able to do that as long as our debt service coverage ratio still hits. Now that's another trick. A lot of times in these primary markets are more expensive, and so the debt service coverage ratio doesn't hit at 80%. So you got to go to 70 or even 60. But our interest rates are going to be the lowest. So right now we can get interest rates in the upper twos, mid to upper twos in these markets, right? It's going to be just a little bit easier to get a loan. They're going to require less reserves. They're going to look at, scrutinize the deal and you a little bit less. Okay. But then when we go to secondary market, when we go to a tertiary market, we really start to see that difference. So secondary market, you might be able to get 3.25%. Tertiary market, you're probably going to be at 3.25% to 3.5%. So you saw we just went, and maybe they won't even lend to it as well. Like if we're in a small market, like you said, like the middle of nowhere, your agencies aren't going to lend in the middle of local bank to lend there. So your agencies, they're not going to lend if the city is 20,000 people. Okay? They're just probably not going to lend to you. They're not going to lend if the city has 3,000 people for sure. Right. So you eliminate part of your debt source there too. But the smaller the market where they'll actually lend, typically the lower your interest or higher your interest rate is going to be. And then they're less likely that you're going to get them to go 80%. They're probably going to go 70, maybe 75% too. And they also classify risk markets too. So there might be markets that have a different risk profile, even though they're maybe a secondary market. So like a Detroit, right? City's gone through a lot. Well, it's a secondary market, but it's not graded the same as every secondary market. It's seen as kind of a higher risk, weaker market. It's a rust belt market, right? So you think of your rust belt, Detroit, Cleveland, some of those, you're going to get worse terms in those markets than you would if you're, let's say we're in Cleveland or Detroit and we go to San Antonio, maybe similar size markets. San Antonio is going to get a lot better treatment because it's not in that rust belt, right? Hasn't gone through the negatives that some of those markets have gone through. So you're going to get lower interest rates. You're going to get better loan to value, where those you just won't. So definitely lending differences for sure.
Hi, I'm Matt Jones, and if you're like me and you're interested in cash flowing real estate, then you've got to attend the North Star Real Estate Conference this October 22nd through 24th. It's going to be a virtual experience unlike any other. You get to network and meet with the other attendees as well as with the speakers, and we've got some big name speakers as well. There's Brandon Turner from Bigger Pockets, Adam Adams, Trevor McGregor. I mean, the list goes on. Check it out now at nreconference.com. There's also a deal flow difference. The primary markets just have a lot more properties, a lot more deals that you can look at, whereas tertiary markets certainly have a lot less, and secondary is somewhere in between.
In a general rule, obviously bigger market means more properties are going on the market. But there's also, I would say, a factor that is kind of depends on the market too. So certain cities, people fly through properties pretty quickly. It's traditional in certain cities to buy property, renovate it, and turn it and only keep it for 5 years or less, maybe even. It's just traditional. Sometimes you don't even renovate it. Sometimes you just buy it, keep it for a few years, and then you go on, move on to the next one. And so that's just tradition, and it really allows for a lot more inventory to come on the market. Think like Dallas, Texas. Dallas, Texas has a ton of inventory because people aren't holding on to the properties. They just don't. There's not a lot of legacy holders in Dallas. Well, take our market, Matt, in Minneapolis, and that is a market of legacy holders. People do not burn through properties. The strategy in the Twin Cities, for the most part, is buy a property, renovate it, rent it, and keep it, and pass it down to your kids, and then grandkids, and then great grandkids. Like we don't have an exit strategy, so that's kind of a typical strategy around here. Now it's changing a little bit, but not enough, I don't think, to make a massive dent in the amount of inventory. So even though we're a bigger market, not massive market, but bigger market, our inventory is smaller than a lot of markets that are even like an eighth of our size. We don't sell a lot of 100 plus unit buildings. We don't sell a lot of apartment buildings, period, just because of 87%, the last statistic I heard, of our properties are owned by local owners, and they've likely been held for decades.
I
so
heard
there is
that.
that difference.
I heard that in 2019, only about 20 large multifamily properties in the Twin Cities traded hands.
That's it.
for the whole year.
For the whole year last year. And I don't even know if it was quite that high, but that's equivalent to Lexington, Kentucky, where I also invest. Lexington, Kentucky has an MSA of 500,000 people compared to 3.8. They sell the same amount of properties in Kentucky, Lexington, than they do in the Twin Cities, in a market that's just a tiny bit compared to the Twin Cities. So that just shows you how we like to keep our properties, and quite frankly, doesn't burn through their properties as quickly as other markets do too. So, so that does make a difference, but for the most part, what you said before, inventory is going to be less in a tertiary market than it is in a primary market, for the most part, right? That's your kind of general rule. So definitely, you're right there.
Cool. And there's also, like I mentioned before, more competition. More people are trying to invest in the primary markets, so you'll have more competition. You got to be more on the ball with, making offers on deals.
But
or am I wrong?
Well, I don't think you're necessarily wrong, Matt. You're right as far as sheer numbers go, but is it right for the deal flow, right? So when I look at how much deal flow I have in a smaller market versus my competition, it might be a ratio that's similar. I don't know. I guess that's interesting. I think it would have more to do with what we just talked about before, where you've got that market like Dallas. Now, Dallas has a ton of competition too. So, but let's just use you got your typical market that sells a good amount of buildings a year, and that could be a secondary market or a primary market. If they're burning through a lot of properties, you're going to have an opportunity, right? You're going to have less competition because there's so many properties. Or if you got a market like the Twin Cities, even though we don't burn through properties just because there's no listings ever. So there's so much competition here. I shouldn't say impossible, but it's very difficult to find a good property here that's not selling for crazy prices, because there's just no inventory and there's so much pent up demand. So I think it depends on the market a bit. I'm not sure if the answer is versus the size of the amount of inventory per population. So I don't know. Yeah. You've got several advantages and disadvantages of each market. I don't know if you want to start off on some of the advantages or disadvantages, as far as like, I guess just why you would want to be in a tertiary or why you'd want to be in a primary or secondary.
I think I base my decision on where to invest more on, bigger statistics. And I suppose that might be a situation there, like crime, for example. If you have a large city center, there's probably going to be more crime than a tertiary market. And that's certainly a factor that you want to take into consider. Is crime reducing, or is it increasing, or staying about the same? And so that could be that there could be that variance between, like a large city center could have decreasing crime, whereas the tertiary could be staying the same or not decreasing as much. And so then you might want the primary market just because the crime is decreasing, but that's more or relation to the crime versus the size of the market. And so I guess I base my decisions more on those stats.
Definitely. So you're basing them on the economic stats and the political stats and the just kind of what's going on in the market. And I agree with you. I mean, that's probably the most important, that we're basing our decision on the market based on more of the jobs that are coming in, the economy, what's going on there, the rent affordability, the political environment, and what they're doing, good or bad, with the city, with landlords, quite frankly. So those are definitely important. One thing that you got to look at too, though, is you can have the best market that you think in the world, and if it's got too small of a population, we do have some disadvantages. And some of the disadvantages, and we do have some advantages too, but some of the disadvantages are going to be finding contractors and finding property management companies and finding lenders for our buildings is going to be a lot more challenging. So that network just becomes a lot smaller if we have a smaller market. Now, if it's big market, that increases the amount of availability. So I mentioned Lexington, Kentucky, and I'll speak to that again because I know it. It's a fairly small MSA. It's got a few property management companies within Lexington, but the nice thing is you've got Louisville and you've got Cincinnati, both an hour away from Lexington, that allows management companies to come into that market. You've got also Nashville, that's only 3 hours away. You've got Columbus, that's only a couple hours away. So you've got cities that are a few hours away that can put their management companies into Lexington because they're close enough. So that works well. But if we're in a market that's especially kind of by itself or only surrounded by smaller markets, then it becomes challenging to find enough property management, find good contractors. A lot easier in a big market. Of course, your prices are typically going to be cheaper, right? So your contractors aren't going to charge you as much typically in these smaller markets. But if you have to fire them, can you find the next person, right? Can you find somebody else to do it for you? We're in a big primary market. It might be more expensive, but man, there's so many companies out there to do the work. There's a lot to choose from. Same thing with property management companies. There's a lot to choose from. So we have options.
Yeah, I think that's completely fair. And I wouldn't say that would necessarily be the deciding factor, but it's certainly something to take into consideration of like, oh, you might have a pain in the butt to deal with if you don't have options to choose from.
So let's talk about today's trends. Today's trends are pointing towards secondary and tertiary markets, right? So today's trends, kind of what's going on is people are leaving some of these really big cities like New York, like Chicago, like LA. They're leaving these big metropolises and they're wanting to live in not small towns, right? Not little tiny towns, but they're wanting to live in smaller towns. So they're going to go from New York and going to they might move to like a Jacksonville, Florida. They might move to, Lexington, Kentucky, although pretty small, right? But they might move into a smaller city, not a tiny town, not a town of 30,000 people or less, but a bit of different type of environment. So I think that's a trend right now. Now, whether that's long-term or short-term, yet to be determined, right? But it truly is happening.
Yeah, definitely. And I agree with you. I don't know I guess we get over this big hurdle with COVID, if that'll sort of reverse itself or stabilize or whatnot.
Yeah, hard to say. Like, is life just going to go completely back to normal? Is it, is this long-term, long-lasting? I don't know. I'm torn. I say I can see both actually. And, we don't know yet, but the short-term trend is definitely towards secondary and tertiary markets are much more favorable for people to invest in. The thing I would say, if you're going to invest in let's call it a really small tertiary market, right? So 50,000 people, 100,000 people, or smaller even. They really, in my opinion, should be closer to your backyard for you to invest in those small cities. And you need to have local relationships with lenders Otherwise, it's just going to be kind of impossible to do that. The biggest risk with these small towns is and this goes back to your criteria, right? We want to have the right criteria. So what's the industry like? What are the jobs like, and what's driving that? So if I've got an economy that's like the one factory town, and if that factory goes out of business, that town is a ghost town. Well, that's a terrible city to invest in. Unless you own the factory, I guess. But man, that's a high risk city. So you better be getting properties for a really good price, because that's very high risk. I looked at investing in North Dakota with the oil that's going on in North Dakota. Well, we're investing in these towns, and I never invested into it, but you're investing in these towns that, basically are nothing. And you're putting up a 150 unit hotel that can be converted into apartment as the town grows. But you're hoping that the town actually grows, because if the oil industry gets walloped, well, then guess what? Nobody needs to live there. Nobody wants to live there. There's nothing to do there. It's not like it's this beautiful city. It's a rural city that had a population of 2,000 people up until 2 years ago, and there's probably a reason for it. It's cold and it's snowy and it's windy, and there's just not big urban core around it. So that's what's going to happen, and that's exactly what happened, right? The oil industry's got smacked around pretty good a few different times over the last 10 years. And it's showing the scars, and the area's seen definitely some trouble. And that's what you risk, right? That's what you risk going into these small tertiary markets, especially the tiny ones that are controlled by an industry.
Exactly. That job diversity is huge, having like different top employers from different sort of industries. So even if one crashes, that you're still going to be able to absorb things to keep things going.
Yeah. And also understanding what they are, like, what are your top employers, and how stable are they? How long have they been in the city? What have they invested in the city? What's their headquarters look like? It's a big move for a company that's got a massive headquarters and a massive employer base in one city to move to another one. What are the tax incentives? Have they been threatening to move? If you've got a company that's been threatening to move and they haven't made the move, well, you probably want to really highly consider that as you're looking at investing in an area that, look, they've threatened over the last 5 years to move. There's probably a reason for that. They're not content there. So there is a chance that they're going to move. And if they move, what does that do to the city? So you got to look at that.
Yep, exactly.
So anyways, I like the kind of secondary markets myself, Matt. I like the secondary or larger tertiary markets that provide you an opportunity to not have these super saturated markets with cap rates that are driven down as far as possible. And yeah, they have a little bit less lending favorability, but still good. Those are the markets that I'd like. Opportunity for, I feel like continual growth. That's what I like to see in my market.
Yep, that's always a plus.
So cool, man. Anything else you want to add?
No, I think that's about it.
All right. Well, Matt, you have a fantastic rest of the day. Make every day Saturday, man.
Yeah, thanks. You too.
Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe. Give us a thumbs up. Go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to
more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.